Hey, what's up everyone, and welcome to the School of Personal Finance. So the stock market continues to be very volatile. We did just have a nice little relief rally for 2 days there, but now it seems like we're giving some of that back. So much uncertainty, doom and gloom out there about the Fed, interest rates, the economy, recession talks, the job market. The only silver lining right now that's coming out of all of this is that interest rates on your savings are actually starting to go up a little bit. So if you're still sitting with a lot of cash in one of the big banks right now, it is time to take a look at other places that you could put that money and actually get a decent rate of return. So in this video, I'm gonna share with you my 4 favorite places to be stashing your emergency fund, all the way up to money that maybe you need 2 years from now or so. All right, let's get to it. All right, so real quick before we get started, go download my free budget template over at schoolofpersonalfinance.com. You could go in, create your own categories, you enter your projected expenses for the month, track everything, and then go back and put in the actual amounts you spend. This is a great way to turn the lights on and see where your money is going every month. And then the other thing is, I just opened the enrollment for School of Personal Finance, the Education Center, again, and I made some updates. I added some new content to my flagship course, Master Your Family's Finances. And then also I added that when you enroll now for a limited time, you get a one-on-one 30-minute Zoom call with me to go through the financial plan that you created when you went through the 10 steps in that course. So go check it out, sign up now. I would love to work with you and help you out on your personal finance journey. Now, I've been talking about paying off debt, being patient, building up some cash, being on a strong financial footing, all throughout 2022. But I've also been saying that make sure you are continuing to contribute to retirement accounts, making those contributions every 2 weeks through payroll deduction, taking advantage of Roth IRAs or traditional IRAs. Don't stop investing just because this economy seems like it's in a tailspin right now and this market is down 25% year to date. You will look back and be happy that you maxed out retirement accounts in a year like this. It does present a long-term opportunity. Not to say the pain is going to stop anytime soon. Nobody knows the answer to that. But just in general, make sure that you continue to always be an investor. So now with that said, it doesn't make sense to keep that cash inside of a big bank savings account anymore. You're just not getting any interest on it. So I'm going to start by talking about just savings and money market account rates that I've seen out there over the last couple of weeks, where if you want to keep your money in cash, why not keep it there? It's going to be FDIC insured rather than keeping it in a bank where you get like 0.05% on it, where you get enough interest every month that it just annoys you because it's pennies, right? So where I currently have my savings account is Capital One 360, and their interest rate is 2.2%, I believe, as of the time that I'm recording this. And then there's banks like Ally Bank, I believe, is 2.1%. Synchrony Bank, I think, is like 2.25%. So it's worth doing a little shopping around, and you could visit like your local credit unions to see if they have better rates. I have a credit union in my area that's paying 2.3% on the savings account. So any of those banks, as long as they're FDIC insured, and you have complete access to get your money, then why not keep it in there and earn, 2.25% compared to earning nothing in one of the big banks. So definitely make that move if you're sitting on a lot of cash in these savings accounts right now. All right, and then the second place is bank CDs. So CD rates have really come up recently. Like Capital One 360, they have a 1-year CD that's 3.25%. And in my area, there are local credit unions that even have 3.4 all the way up to 3.5%. So now you just want to make sure, again, that you're using an FDIC insured bank to get your CD, and that you're not going to need that money in that 1 year or whatever time frame you choose for your CD, because you have to break the CD, then you're going to get hit with penalties and it's not worth it. So 1 year CD, 3.25%, again, much better than sitting in a savings account where you're earning basically zero. And then the third option, which is becoming very appealing, and that is US Treasury Bills. So if we look at the US Treasury Direct website real quick, so you could buy them directly through the US Treasury site. You could also buy Treasury Bills or Treasury Bonds, Treasury notes. You could buy them through a brokerage like TD Ameritrade or Schwab, and that might be a little bit easier because the US Treasury Direct website is kind of antiquated. I don't know if you remember with I-bonds, I made a video step by step how to go ahead and purchase I-bonds, just because it's so complicated to go into the website and actually complete the transaction. But you can buy them through the Treasury Direct website, or like I mentioned, through any of the big brokers out there. And with these Treasury bills, they have auctions. So like with the bills, they're auctioned off every week, and you could go in in, then you can place your order ahead of time so that you're able to purchase at the auction. So with the brokerage houses, I always recommend, like, call the broker. If it's TD Ameritrade that you use or Schwab, give them a call, have them, walk you through it so that you make sure that you're doing it correctly. Through the Treasury Direct website, you could just go ahead and place your order in advance, and it's really not that difficult. I just don't like having to deal with that website and owning anything in it. I would rather own these Treasury bills in my brokerage account instead. And now the maturity, as far as the maturity goes, you want to hold it through the maturity so that you're guaranteed that you earn that interest rate, right? So for example, if you buy a 52-week, a 1-year Treasury bill, the rate right now is a little over 4%. So as long as you own that, you hold it for 1 year, then you're guaranteed to get that rate. If you need to sell it prior, you can do that. You can liquidate it. There is always a liquid market for these Treasury bills. So you can sell it, but the amount that you get back will depend on where the current interest rates are. So with bonds, if interest rates go up, for example, right, let's say 6 months from now, the 1-year Treasury bill is paying 6%. Then your 4.15% Treasury bill, it becomes less valuable in the marketplace because people could just go ahead and buy that 6% one. So the value of your bond will go down. But as long as you hold it to maturity, then that takes it out of play. Then you're guaranteed to get that rate that you signed up for. You hold it for the year, and then you can decide what to do at that point. But let's just quickly look at the website at what the current rates are. I think this was from the last couple auctions. So yeah, so the 52-week, the 1 year was at 4.134, the 13-week, 3.415. I mean, that's also very attractive to just, basically 3 months to have your money in there. And then you could keep rolling it every 3 months if you want to. The 26-week, just under 4%, which is great. The 4-week, 2.7, 8-week. So all these different options that you could buy with these US Treasury bills. So that's a great place right now to just store cash. I mean, so it's not FDIC insured, but it is backed by the full faith of the US government. We're all worried about the debt and the deficit that's going on, the money printing in this country, but the government has never defaulted on their obligations for borrowing money through these types of, Treasury bills or Treasury bonds. So I guess worst case scenario, if they have to, they're just going to print more money to make sure that they're able to make these debt payments. But you have to feel very safe and secure buying US Treasury notes. It really is a risk-free option. So we're currently in an environment with an inverted yield curve. So what that means is that the 2-year, even the 1 year, is paying more than the 10-year. And that is not common. Usually the longer you tie up your money in these bonds, the higher interest rate that you get, right? Because you're locked in for that period of time, so you require a higher rate. But right now, with an inverted curve, the short end of the curve, the rates are higher than on the long end of the curve. And that usually is a sign that we are either going into a recession or that we're in a recession. So having a 2-year at 4.15 and the 10-year at 3.84 or whatever it is right now, that is an inverted yield curve. So with treasuries, they're paying better than savings accounts, than the CDs right now. You just have to go through the process of actually purchasing them, either through the Treasury Direct website or through your regular brokerage account and going ahead and doing it. But it's worth the little bit of effort, especially if you're sitting on a lot of money. I mean, it's perfect if, say, for example, you are saving to buy a house, maybe 2 years from now or so. Then to buy like a 1-year treasury or a 2-year treasury, that could make a lot of sense, where at least you're getting some interest, your money is safe and secure, and it gets it out of your grubby little hands, right? You're not tempted to use it for anything else because it's kind of tied up. Even though there is liquidity options, if you did need to get out of it and do something, you want to not bank on that. You want to be actually buying it for the time frame that you're going to hold it, so you don't have to worry about where interest rates move if it's going to reduce the value of the bonds that you're holding. So you want to hold them through maturity. Another great thing about treasuries is that they are not subject to state and local income taxes. The interest is not subject to them. So you still pay federal taxes on the interest, but you don't have to pay state and local taxes. So just another nice additional benefit to owning them. All right, and then for number 4, I'm going to throw individual bonds, municipal bonds, and bond funds all in this category, even though they all are very different. But the reason I'm kind of throwing them together is because they all take more work. They all take more research. There's more risk with them. You really have to understand what you're getting into. And they're not a great place for an emergency fund like the other options are. But if you have some savings where you have a definitive time that you want to have this money, locked up, then these options could be good. So I'll run through them real quick. So like with individual bonds, you could buy a bond from a company when companies need to raise money. Like if Tesla wants to raise money, they issue bonds, you could lend them your money and they will give you, say, a 5-year bond at a certain interest rate, and the interest rate's going to be a little bit higher than Treasury bonds or Treasury bills because there's more risk, right? Because now you have to put your full faith and trust in Tesla that they are going to repay you your money. They're not backed by the government when you buy a corporate bond. And then municipal bonds, it's kind of the same idea. It's just you're lending your money to a municipality. And most of the time, those are going to be tax-free, depending on what type of municipality it is. It could be federally tax-free, state tax-free, local tax-free. It could be all three of those. So those could be an attractive option, especially if you find yourself in a high tax bracket. And with bond funds, you're buying a basket of bonds wrapped up into a security, like a mutual fund or an exchange-traded fund. And there's all different types and flavors of bond funds: short-term bonds, mid-term bonds, corporate bonds, municipal bonds, government bonds. I could go on and on. So you really have to know what you're getting yourself into. And they're going to fluctuate. So as interest rates change, the value of the underlying bonds in the fund, they're going to go up and down depending on which way interest rates go. So like 2022 has been a terrible year for bond funds, depending on what types of bonds they are, because interest rates have gone up. So when interest rates go up, the value of the underlying bonds go down. All right, everyone, that is it for this one. As always, nothing that I talked about in this video is personal investment advice for you. Make sure to do your own research before pulling the trigger on any of these things. Let me know down below if you found rates that are better than the ones that I talked about in this video. Make sure to hit that like button if you enjoyed it. I'll see you in the next one. Thanks.